Hey everyone, today on the final bar, my guest is technical analyst Kim Sokoloff. She's a fellow CMT based in the New York area. Going to share with us a couple charts, a broad market chart, and also an individual stock to pay attention to. You know, the market sort of continues to frustrate, never really breaks out, never follows through, and we need it. And today we get a little more distribution remaining in that sort of 53,000 range, still waiting to see which way we resolve from here. We're also going to dig into fishing on alpha and look for some stocks making some new highs to see what the next step may be. Ladies and gentlemen, this is the final bar. Hello, everyone. Good afternoon. Welcome to the show, The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close to look at the charts together, try to make sense of what's happened today, try to connect today's action to the long-term trends, understand the context that all these individual days line up at. As I mentioned in the introduction, I think, and I was talking with our guest, Kim Sokoloff, before we started the show, and it's which one of these things is going to happen, right? I mean, we've been in this range now for about a month, about 3 to 4 weeks, been in this, fluctuating between two clear levels, and every time it feels like we're going to break out. We have a day like today, which is more of a right sizing, more of a normalization. Anytime we've tested the lower end of that range, buyers have come right back in and pushed it higher. So, buyers, sellers not really taking control here. So I think, the challenge is really, what do you do? And I think hopefully in our segment, Fishing for Alpha, we're going to dig into some individual stock themes, look for some individual ideas, because I do think regardless of the overall market direction, there are opportunities out there if you're looking for them effectively. So hopefully it should be a good discussion together as we look for some ideas together. I do want to point out some of the great guests we have. We have Kim today, and next week, we're going to take Monday off for Memorial Day, but we'll be back live on Tuesday. On Wednesday, we have Katie Stockton joining us from Fairlead Strategies. And then on Thursday, the 28th, Ryan Dietrich, who's a great technical analyst at LPL Financial. Also on Monday, even though it's a holiday, we're going to keep running our show Behind the Charts. It's an interview style show. We sat down with Joe Duarte not too long ago at one of the Money Show conferences. Joe's fascinating. He's an anesthesiologist that turned his attention to equities and equity derivatives, the options markets, written a number of books on that. And does a really good job of just making sense of the charts. So it'll be a really cool discussion to hear how someone with his background, gravitated toward technical analysis. So a good show on Behind the Charts this coming Monday. As we look at our market recap, I think, the question on so many investors' mind is just what's the next leg? If you missed the sell-off, hopefully you didn't. You saw some of the warning signs, but that's behind us. If you missed this bear market rally, hopefully you saw the increase, the optimism that came out of the lows. And if you missed that, we're now kind of at this midpoint. We're at this equilibrium point. I think, remember, the markets go up, down, and sideways. Those are the three directions. And if you look at a daily chart of the S&P, we are in direction number 3. We have experienced all 3 directions in the last quarter. We've had down, we've had up, and now we are decidedly sideways. And while I've heard many people justify this is a pause before the next leg higher, and we've highlighted this potential bull flag pattern that appears to have been confirmed, which would measure well beyond the February highs, but at the very least suggest a retest of those highs. We've had some guests that sort of confirmed that outlook. On the other hand, we sort of have the uptrend is exhausted. We're at the ultimate resistance line. The line in the sand, S&P 3000, is resistance. It's the 200-day moving average. It's unreasonable to expect we'd go much further. So we're waiting for the next leg down. And at this point, I think people are just waiting for direction. So, we didn't get it today, unfortunately. So yesterday we had this nice rally. Today we sort of pull back a little bit, and certain charts being more of a distribution pattern from candlesticks, right? More like a bearish engulfing pattern or something like that. Not necessarily on the S&P, but in some other charts for sure. Again, when I think of the base case that I've been operating on, it's this bear market rally thesis until we break above 3,000. I think that's still reasonable to expect. The fact that the RSI remains below 60, again, that's just classic for a bear market phase. But if and when we break above 3,000, I have to throw in the towel and say we're in a new uptrend. Again, some of my rules-based systems and that intermediate time frame has already turned positive. If the week would close where it is now, it's sort of telling you that the trend is positive. It's continuing. Again, we keep making higher highs and higher lows, and that's what's most important for the short-term read. Let's look at what happened across the markets. The S&P actually finished down just below 2950, so just the lower end of that range that we've been talking about, that congestion area. Mid caps and small caps actually up on the day. Small caps really flat, but mid caps up about 1/3%. And the VIX back up, not above 30 yet, just above 29, but elevated from where it was at the end of day yesterday. When you look at some of the sector themes, consumer discretionary and industrials, the only two of the 11 sectors finishing positive. And within consumer discretionary, it's actually interesting things. Some apparel retailers, things like Ross stores and others actually did okay today. L Brands was up pretty good today, nice gap higher. TJ Maxx as well. You can see the three biggest gainers in our scooter rankings. This is based on a trend following system. As I show you the little preview charts, Ross stores testing its long-term high. L Brands breaking out of a resistance range. TJ Maxx actually breaking to a new 52-week high today. So some of the stocks within consumer actually broke up very nicely, but the average stock finishing lower, with energy leading the way down, 1.5% down. Technology second from the bottom at 1.3%, and the consumer staples down, and utilities both down about 1%. So, it's sort of a mixed bag of sector movements, but consumer discretionary really the sole bright spot today with some interesting breakouts. The rest of things were sort of more distributive than showing accumulation. When you look at some non-equity markets, bonds up a little bit. A lot of that came in that first hour of trading. Since then, it's sort of tapered off a little bit, but the TLT did finish about 1/4% higher than yesterday's close. In terms of commodities, gold down pretty big, kind of a gap down into the open, sold off pretty aggressively into the first hour or so. Recovered a little bit, but still down about 1.5% from yesterday. Oil was one of the rare, particular parts of the market that ended up finishing pretty strong, with the USO up about 5% today. So sort of, again, a mixed bag. And again, this is pretty reasonable to have this sort of pattern when you think about what's happened up until now, right? The big distribution February to March, the big rally into the peak last week in April. And again, since then, more consolidation than anything else. Let's continue our journey looking at some of the different stocks, emerging in positions of strength, positions of weakness. Not much up on the day when we look at our global ETFs list. Brazil was up the most, 4%, frontier markets and some others. But again, on average, most things were down pretty significantly. And anything related to China really led the way lower. So the KBA, which is tied to the A-shares market, sort of the domestic market in China, down 2%. The Hong Kong market, which some of the more larger, more developed, more international, multinational companies listed in Hong Kong, down almost 4% today. So certainly weakness coming out of that particular region. As I mentioned, with industries that were leading, interesting to see apparel retailers. This is a group that has not particularly done well, but you can see looking at the chart how it's actually jumped up pretty nicely. And as I mentioned, some of the stocks within these groups doing better. Something like TJ Maxx and others, they're coming out of really beaten down levels. So again, it's hard to get too excited about it, but I am excited to see a pattern. This was something that had continued to make higher highs. We have another higher high. This last swing lower made a new low. So all of a sudden you have this broadening pattern of higher highs and lower lows, which is pretty rare actually. You usually will have a break and a consolidation. This is not one of the more popular technical patterns. We have a broadening pattern. It usually is a reversal pattern. And it's because I've always thought of it, the increasing in the lows is the problem. It's not the move to new highs. It's the fact that the lows keep getting lower, and that sort of outweighs things. But you can't deny the fact that apparel retailers up, with an RSI breaking above 60, breaking above the 50-day and following through, breaking above its swing high from the end of April. That's more than other groups and other sectors could certainly say here. So maybe worth a bit of a look if you're looking for opportunities, and again, particularly some of those names that have had some interesting breakouts. Other industries that are up positive, some insurance groups. So this is within financials. It's when we think of financials, we tend to think of it as the big banks. And you have to remember with financials, it's actually a relatively diverse group because you have some really defensive parts like insurance, reinsurers, property casualty insurers. These are all life insurance. These are all within that bucket. So the banks are certainly the biggest cap stocks, but there are some groups that actually did well today. So don't think of them as a homogenous group necessarily. There are some some pockets of movement in there. Also within real estate, you had one of the real estate groups, holding and development, that was one of the top five. Aerospace actually at the top of the list, which has not been a consistent place there. Aerospace and defense names have struggled certainly recently, and airlines as well. And again, with a lot of these groups, it's interesting to see them up. I always would hesitate just seeing it up today. I would focus more on the trends. These are all, again, if you just look at the little preview chart that I'm bringing up here, you can see that the airlines index, even though we've been up in the last week, continues this pattern of lower highs and lower lows. And until that pattern reverses, I hesitate to get too excited, on the long side with that. Worth noting on the downside, the two worst groups out of our 100+ industries was miners and gold miners. Newmont Mining has been one of the top ranked stocks on our scooter rankings. Also up on the or down on the list pretty bad. Semiconductors. One of our 3 and 3 charts yesterday was looking at the semiconductor index, the relative strength, which is just breaking out. We pulled back a little bit today. Overall, I think it's still in a pretty decent place. This kind of came down with everything else today, but overall, semiconductors tend to do well. They tend to outperform in positive markets. That's sort of the general sense of it. So when this group is doing well, it tends to be a good bellwether for the overall market environment. Overall, relative is holding up pretty well. And even though it pulled back today, I think the pattern's still relatively constructive. So an interesting chart to continue to watch. But if it keeps being on that lower end of the industry list, I'd be a little skeptical going forward. Let's take a quick commercial break. Back with my guest, Kim Sokoloff. We'll see you in a minute. Hello, everyone. Welcome back to the show. This is Dave Keller here at StockCharts.com. Thanks for joining us every weekday for the Final Bar. As a reminder, a couple times a week, we do a mailbag segment. We'd love to answer your questions, help you understand this market environment, answer questions about technical analysis, charting, visualization, behavioral trends, whatever it is, we'd love to answer your questions. So just shoot us an email, thefinalbar@stockcharts.com, or just look us up on Twitter @FinalBarSCTV, and we'll look to answer your question later in the week. I want to welcome on my guest, Kim Sokoloff. Kim's joining us from the New York area. She's a technical analyst and with a great background in trading. So I love talking with people like Kim who apply a trading mentality to the charts. She's at Allied Millennial Partners in New York. Kim, welcome to the show.
Thank you. Thank you for having me.
It's awesome to have you on. And you sent a couple charts ahead of time. We talked a little bit before the show and leading up to it, just about how you use things like stochastics to try to make sense of the trends. We're starting with the chart of the S&P. What are you seeing here?
Well, it's really great. So if you could see, I put arrows, you can follow along. I put arrows on the chart. So dips below 20 warn of oversold conditions that could potentially lead to a bounce, and moves above the 80 warn of overbought conditions that could foreshadow a potential decline. So let's look at March 23rd. All 3 indicators, MACD, RSI, and stochastics, were very oversold. But keep in mind that any index or stock that's really this oversold can stay oversold for periods of time, as well as can stay overbought. But since all 3 were extremely oversold, to me, it was a very good risk reward to enter the market. From there, you could see SPY bounced from roughly 218 on March 23rd up to as high as 263 on 331. Okay, right. And at that bounce, you could see now stochastics is back above 80. Okay, so at that time, so you can see stochastics is now above 80, and odds are the market could potentially pull back in. And what it did was it went from 263 and dipped down below to 243, and stochastics pulled all the way back to oversold, back to roughly to the 20 area. So this is another great opportunity if you feel comfortable, to enter into the market or add to your position if you entered, let's say, on March 23rd or near March 23rd. Okay. But so you could see with the SPY chart, stochastics keeps oscillating between the 20 and 80 level, giving you buy and sell signals. Whereas you could see RSI kind of, even through now, kind of flatlines and stays around the 50 level. So if you are a trader or just someone, or a momentum or swing trader, I feel like stochastics kind of could add to your overall, your positioning and your strength and how you want to position yourself in the market.
It's interesting because I often talk on the show about just the different time frames, and remember, to use a toolkit that's in line with what time frame you're trying to operate on. And this, to me, certainly speaks. If you look at the last, couple months, I mean, it's certainly been fascinating at identifying those short-term peaks as we've sort of been in this range-bound environment, right?
Right, and there are opportunities, to come in, add to a position. I mean, I don't know if you want to go short, go long, in between, but it really does. The way it oscillates, it really kind of gives you a little extra gauge and a little extra confidence.
So if you could give us a quick read on where we're at. So now we're once again in the overbought condition. Does this mean on that tactical time frame we should be expecting a bit of a pullback here to sort of?
We can, but then, and then we have RSI that's just hanging around the 50, 60 level. So it's not, so we can say, like I mentioned, mid-April, like around April 13th, for like 5 days, we hovered around that overbought level. Okay.
Right.
So you could stay overbought for a while, as well as you could stay oversold for a while. So we could stay at this level or pull in. We've been, range bound for about 6 or 7 weeks right now. So I know we keep saying I hope we break through the 200-day moving average. There's a nice gap on the SPYs at 300 spot 101. It'd be nice to close that gap since the Qs closed their gaps this week, so maybe potentially, right?
It's interesting, and I think that's great. That's a great comment, because I think a lot of people, especially when they're getting started, they think of something's overbought, that immediately means it's going to come down, but things can stay in those overbought or oversold regions for a period of time, right? Now, the second chart that you sent was on Goldman Sachs. We talked about financials a little bit recently on the show. I'd love to know how you apply the toolkit to a larger bank here.
Yes, just one more thing on the S&P in general, though. We want to roughly continue to hold like the 29.10 level overall. We break below that, then we could see further downside.
Got it. 29.10. Okay, good.
Yeah, around there roughly. So now Goldman Sachs, so I just want to give you an individual stock so you could see that it works the same way. It holds true. Once again, you have my first arrow, at the bottom, roughly at the, on March 23rd, we dip as low. All oscillators are, all indicators are very oversold. We dip roughly at the 130 spot 85 level, and we have a huge bounce up, a few days later, up to 167.
Mm-hmm.
Okay, now at this level, 167, you could see how stochastics is now very overbought, right? Whereas the other indicators, RSI and MACD, are just still flatlined or still oversold.
Sure.
So you see Goldman Sachs move once again as high as 167. Where to go? It dropped all the way back down to 141.67. That's over a 20-point move.
Right.
If you're trading that, it could give you a signal if you went long to maybe potentially, rein in your long position, or also a great way to add to the stock. Like say if you didn't buy it, the original first dip down to 130.85. And also I use moving averages as well, of course, for confirmation. And then you could just see once again how like RSI just kind of flatlines, whereas you get these oscillating, these big swings in stochastics, and it gives you opportunities to enter and exit individual stocks.
Kim, those are two really good examples, and I love that. I rarely use stochastics on the show, which is why I'm super happy that you brought these with you and talked through them. Because I think for, again, thinking from the tactical time frame, you've made a great case as to why it's really helpful for identifying those turning points. Kim, we have to move on. This was so good to have you on the show. I'll look forward to having you back down the road. And again, stay safe in New York, all right?
Thanks so much. Have a good one. Thanks for having me.
That's Kim Sokoloff from Allied Millennial Partners in New York. And again, I've always learned over my career, I have to be very comfortable with my toolkit, and I have to be very open to talking with people whose toolkits are a little different than my own. And I love talking with people like Kim who are thinking a little more short term and are identifying, using charts to identify some of the short term price swings. And I think, with both of those, I think with the S&P chart, I hadn't really paid attention to the stochastics recently. Interesting to see that it's approaching that overbought region, and I jotted down 29.10. We'll see if we remain above that. But thanks to Kim Sokoloff for joining us today. Next segment, folks, is fishing for alpha. So what we love to do is apply regularly sort of a screening exercise. Where can we look for opportunities? And as a reminder, we spend a lot of time on this show just because of the limited time. It's hard to get into a lot of individual stocks. So we focus a lot on the broad market, on asset allocation, on sectors, because there are always there's plenty to talk about there. But I think one of the great benefits of technical analysis is to look at a big universe of things. And especially if you're an equity investor, there are always opportunities out there. There are always stocks breaking out, breaking down. You just have to know how to screen for them, how to look for them. And again, on StockCharts, we're pretty fortunate to have a scanning engine that allows us to sort through the equity universe pretty easily. So I want to share with you just one scan that I look at. We haven't looked at this too recently, so I just want to bring it up and show you some of the results here. One of the things I screen for all the time are stocks making new 13-week highs and stocks making new 13-week lows. On the show, I tend to limit this to the S&P just so they're stocks that we all probably are familiar with and it's going to resonate with us. We can make sense of them. But remember that what we're showing here, you could easily apply to a different universe. You could screen for particular types of companies, even ETFs. And I think a lot of the tools should be very, very similar. It'll map very well to other baskets of stocks. So don't feel like I'm limiting just to this as an idea generation tool. You can really tweak the universe as you need. So what I look for, this is as of yesterday's close, because we pulled back a little bit. So there's only 3 or 4 stocks in the S&P that were making a new 13-week high on the close today. On yesterday, we obviously had a more of an update. So we had 20 stocks out of the S&P that went higher, so about 4% of the universe. So what I did, I dumped them into the scanning engine. I'm going to sort them by sector so we can just look at some of the themes, and then we'll look at these charts very quickly, just going through them. One thing that immediately jumps off, half the list are technology names, and we've talked about that. The narrowness of leadership on a sector basis, and if you look at the relative performance of the XLK, it just continues higher. And a lot of my guests have talked about the XLK, the Qs, or something like that, just because again these stocks have tended to do really well. And it's not just one group, and it's not just the mega cap. There's a mix of things. There's some semiconductors, there's equipment names in here, services. PayPal is one that pops up here. So it's a pretty diverse group within technology. You also have a handful of healthcare. You have 3 of them on here, biotech, but also other groups as well. And then some consumer discretionary groups, and Amazon certainly jumps off the page. Facebook, so you have some of the FANG stocks that certainly have scored pretty well here. I dumped all these charts into a list real quick, just so we could start to review them. And again, what's interesting with today, you can see how a lot of these broke out yesterday. They've come off a little bit, but overall still holding up pretty well. So Facebook, even though it gapped higher, finished down or closed down at the lows for the day, still above this high from January. So yesterday was a big breakout, getting above those levels. And again, even though we distributed today, remaining above that sort of breakout level is pretty key. So holding the low from yesterday around 223, I think would be really important if we get any sort of further pullback. Noteworthy that the stock is overbought now. That doesn't, as Kim was illustrating earlier, doesn't necessarily mean it's going to go down. Not necessarily a bad thing. All this means it's gone up a lot. When we start to diverge, or when we start to come out of that overbought region, that's why I would be watching Facebook right about here. But overall, setting up pretty constructive. Take 2 is a little more concerning. You can see this is a big pullback today. This is after 4 straight days really, of these big up days, breaking out of this huge base. And while I still think the group overall is doing pretty well, as a individual name, down almost 6% today and retraced most of those last 2 days. So again, though you don't want to overreact to one trading day, you want to look at the pattern of highs and lows. And what strikes me here, even though we've pulled back today, we still have a pattern of higher highs and higher lows. So you want to see on any pullback, if we're able to maintain that. Chipotle is a fascinating chart, and the relative performance that just continues. And again, just the trend has been positive, broken above the February highs, remaining in a position of strength. Amazon is noteworthy because we did get a bearish engulfing pattern. I mentioned that in the intro, some stocks had. Amazon maybe the largest, most liquid one that I would want to point out to you. What also strikes me on the Amazon chart, higher highs in price, lower peaks in the RSI. This is a bearish divergence where the momentum is coming off a little bit. And again, it's a bit of a concern, with the market where it is approaching key resistance, a stock like Amazon, a bearish engulfing pattern and bearish divergences. So a bit of a question there. S&P Global, when you look at financials on Twitter, I had someone write back when I was talking about the XLF versus the XLK. We featured that yesterday in our 3 and 3. What's interesting, some groups within financials have actually done very well, and S&P Global is one of those. That same group with MSCI and other exchanges, sort of information providers, market data, and on a relative basis has done very well. It's interesting though here, breaking to new highs, but has not followed through. From the day it broke above that high from February, it's sort of stagnated. You get these long upper shadows, what you call it, or long upper wicks, so that the high is well above the open and close. And that doesn't tend to be a super healthy pattern, but again, the trend overall is still remaining relatively positive. I want to just hit maybe one name or two further. Healthcare, this is interesting. Healthcare as a sector overall has done very well. The relative strength has tapered off a little bit. Hologic, HOLX is one stock that's come up on some screens. Again, the concern here, overbought and right at previous resistance. So if you believe the S&P is going to go above 3,000 and you believe that there will be a next leg higher driven by leadership names, I would personally want to see a stock like this break above the previous high and continue on to new ones. And I'll finish off on a positive note, perhaps. ABMD is one stock you think about. I love to look at stocks that have this classic rotation from distribution to accumulation. This is a stock that has been in a primary downtrend for a while and now in a primary uptrend, higher highs, higher lows, just testing resistance, but breaking above the 200-day moving average and so far remaining above it, the relative strength improving. Actually, an interesting name within medical equipment. So not a name you may have looked at as much, but actually does pretty well from a trend following perspective. So again, not necessarily with that exercise, fishing for alpha, looking for a bunch of new buy ideas, but I think looking at the stocks that have broken out and looking at the charts to see where they're at relative to key levels can be really, really interesting. And again, what concerns me with that list is there are a lot of stocks that are sort of at that potential failure point. And I think it mirrors what we've seen with the S&P bumping up against significant resistance. That is our segment, Fishing for Alpha. We need to wrap the show and go to the 3 and 3 chart. Number one, this is a new one, the equal weighted Qs versus the cap weighted Qs. We've talked about the QQQ and the leadership of technology in the NASDAQ 100, obviously very technology weighted, so has done very well on a relative basis. If you look at the equal weighted Qs, which is QQEW, do a ratio of that versus the QQQ, you can see how the relative strength has been pretty negative for 8 or 9 months. So we talk about the narrow leadership, the flock to mega cap technology, and this chart certainly speaks to the fact that the equal weighted version is suffering, telling you that it's the larger cap names that are really the story there. The second one is looking at breadth in the forms of percent of stocks above their 200-day, above their 50-day. I think it's interesting to see that this breadth measure has continued to break out. So we now have over a third of S&P names above their 200-day. I'd love to see this get above 50%, which would tell you that the average stock, more than half the stocks are broken above their 200-day. We are not there yet, but getting closer. So it'll be interesting to see how that trend potentially evolves. Also, over 80% of S&P names have recovered above their 50-day. That's up from 0 about 5 or 6 weeks ago. Finally, Cisco is an interesting name. If I had one stock to look at besides one we've looked at so far in the show today, Cisco might be it. It's testing a declining 200-day moving average from below. It just broke out on a closing basis yesterday, back below it. And I think looking at stocks like Cisco, and if they're able to hit above there and move higher, get an RSI above 60, that would be incredibly positive. If stocks like Cisco pull back, if the RSI remains topped out around 60, if you see the relative strength taper down a little bit, I'd have to be concerned about potential future upside for stocks as a whole. Folks, that's our show today. I want to thank you for joining us every weekday for the Final Bar. Check out our YouTube channel for all of our previous episodes. A special thank you to Kim Sokoloff from Allied Millennial Partners in New York for joining us today. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.